What is up, and welcome to the July 2023 market update. Well, if you're living here in Arizona, I think we're on I don't know what it is, 3 or 4 weeks it feels like of being over 110 degrees. So it's pretty insane. It's super hot. And I think all of us are losing our mind a little bit here. And in the midst of all of this stuff going on, we still have this wacky thing going on with our real estate market. And I want to talk to you guys about a few things that have shown up in the news lately. And then I want to just give you a general overview of the market, what's going on, what we're seeing, how people are feeling out there, interest rates, all that good stuff, like we always do, so you stay up and informed on everything. So even though rates have continued to climb and everyone's expecting the Fed to raise rates again next week, we are still seeing a pretty strong market. And the reason for that is low supply. Currently, we're sitting at about 11,200-ish active listings right now. We're down from about 11,800. So we're continuing to see that inventory contraction. So why are we seeing that? Well, we're seeing that because rates keep going up. I think everyone kind of understands what's at play here. And so it's been a funny equilibrium the last 3 or 4 months where inventory continues to shrink. Our average amount of sales per month is also shrinking a little bit, not a lot in both cases anymore, but enough to keep them in balance basically with each other. And it's still a bit of a seller's market. Now I'm gonna give you a little bit of an example of kind of the opposite of this slowdown that some people think maybe would be happening with higher rates and stuff. I'm really gonna talk about this in the context of if you're a seller and you have a house that needs a lot of work or you've inherited a property. We got referred a client. The person that stood to inherit the money is a young guy, he's in the military, he's serving our country, great guy, great family, and we want to get him a high price. He's got a number in mind that I think's much lower than he should really get for it, but he is insistent he'd be happy to get that as long as he can get it quickly and doesn't have to do repairs, stuff like that. Within an hour or two of the home going on the market, we get an investor offer, $35,000 under what we've listed it for. They've given us 2 hours to respond, and it's all cash, close in 1 week. When I present it to him, he's inclined to just take it and be done with it. But I really felt like he was gonna be leaving money on the table if we did that. And so I convinced him and the executor to give me the weekend. 2 days later, we got a $486,000, so $36,000 higher offer, all cash, 1 week close. They're super pumped. All the same things from the first offer, but by just utilizing supply and demand, by letting the market tell us what it was worth, he was able to put $36,000 more in his pocket. Before you do anything, find someone you trust, get them out there, get a great value on it so you can absolutely maximize what's in your pocket. The next thing I want to talk about is this idea that a bunch of people have up vacation rentals and now the occupancy's crashed because COVID's over and they're all gonna be forced to sell them because they're gonna lose them to foreclosure if they don't sell them. Pre-COVID, the occupancy rate for vacation rentals was around 50-55% or so. Right now, we're kind of hearing around the 55-57% occupancy. So basically we're back to pre-COVID levels. There is probably a subset of investors that bought during COVID that were getting a great return, that had really high occupancies, maybe 70, 80, 90% occupancies, that were printing cash, that are no longer printing cash and may be frustrated. And we are starting to see those in areas like South Scottsdale trickle onto the market. So there is definitely a little bit more inventory coming on the market from that, but it's not enough inventory to move the market. So the question is the flood coming? And the answer is, I really don't think so. If they're sophisticated investors, they probably did what's called underwriting the deal. So in other words, they worked their prospective financials out 2 different ways. One is a vacation rental and one is a long-term rental. So for example, I'll use myself personally. We have a place in Flagstaff. We use it as a vacation rental, but when I bought it, I took the worst case scenario, which is that I can't afford to keep it and not rent it, and it's not vacation rentaling, and I have to put a tenant in it so that I'm not upside down the mortgage every month. And I ran the math and I could still live with it. In other words, I would have probably bought that rental even as a long-term rental from the very beginning. I think most sophisticated investors, they underwrote their deals like that. And so we're seeing those turn into long-term rentals, but we're not seeing them flood the market. So that may be different in different parts of the country, but at least out here, we're really not seeing a massive impact on our inventory based on that. So if you saw that article, that's my 2 cents on it. We'll keep an eye on it, but right now, I don't see anything really happening with that. Hope this update was helpful. Can't wait to see you all next month. Please stay cool and hope you're having a great day.